Welcome to This Week in Venture Capital. It's our 17th episode. My guest this week is Dan Primack, who will be joining us via Skype from Boston, and of course, the lovely Lon.
Thank you.
Who's on many shows. We have Lon here in the studio. Our goal this week is to talk about all things venture capital, what's going on in the industry. Want to cover off on some of the deals. There's some very interesting deals, and we'll lead in a moment with some breaking news on a deal. And of course, we always make sure to thank our sponsors. We'll talk about them later. Our sponsor this week is LegalZoom.
LegalZoom, yeah.
LegalZoom, someone that we're very happy represents the show. So I want to kick off with Dan. For those of you who don't know, Dan founded and is the editor of a website called PEHub, PEHub.com. And what PEHub does is it reports on what a lot of entrepreneurs look at on TechCrunch for, which is the leading kind of deals of the week, what was funded, what was sold, etc. PEHub does it from a very financial standpoint. So every VC that I know, every private equity individual, the later stage guys, tend to read PEHub. And I think it's a very unique angle on deals. And they talk a lot about what's going on in our industry. So for entrepreneurs, you may be interested in it, tune into that. Dan, why don't you go ahead and just tell us a little bit about your background? How did you get the idea for this? Tell us about the starting and the formation.
I kind of fell into all this kind of backwards. I followed a girl to New York long ago and suddenly realized I needed to pay the rent, so financial journalism seemed to work. PEHub launched, really kind of the genesis of it was almost 8 years ago. We launched kind of a daily publication to compete with VentureWire, kind of as a deal book sort of thing, as an email. That kept growing. We now have about 60,000 daily readers. And we launched a website about 3 years ago to kind of be a complement to that. And it really, as you said, it kind of covers the money behind the innovation more than the innovation itself. We're not going to be the guys, the TechCrunch that's going to go real deep into a company, a startup, and say, this is why it's good, this is why it's bad. We're more interested with the money, where it comes from, and kind of what's happening on that side of the market.
Awesome. And you are, so PEHub itself is part of Thomson Reuters, a much larger kind of media empire. You want to just give us kind of 30 seconds on that?
We're kind of, I don't know if we're the ugly stepchild. We're the folks that they like to talk about. It is kind of one of their more innovative sites. They don't pay all that much attention to us, which is actually fantastic. We're kind of an odd, Reuters is, a giant news company. the Thomson part of it, tons of data, including venture capital data. And we're, I think, one of only two blogs within the entire, multi-$18, $20 billion company. So we scoot along pretty nicely, and they don't bother us, and we don't bother them.
Super. The one thing I can say, and why I like reading Dan's stuff and talking to him on the phone and seeing him on video, is he's not afraid of a strong point of view. I mean, too many people in our industry are afraid to call a spade in the financial services industry, because if you operate in it like I do, you have to be a little bit careful. Dan has been very ahead of the curve on championing issues like reform of venture capital carry as one of the issues. We may have a slightly different viewpoint on that, but not too far aligned from that. But I like reading Dan for being not just reporting only the facts, but having a strong voice.
I appreciate it.
Dan, we're going to do some breaking news. You've been preparing for this. I know you've been sitting and waiting in the Skype terminal. You may not have even yet seen this, so I'm sorry to surprise you, but it's so interesting, which is that Google just announced, or TechCrunch is announcing, that Google has just purchased Slide. Slide being the original, let's say, widget company on Facebook. The idea, I think, were they the ones who had Poke and Super Poke and all these? And so the idea was you would have widgets that existed on your social network. They would be engaging with the audience. And I think the first real two players in this space were Slide and were RockYou.
Right.
If I look at Slide, founded by Max Levchin, I hope I'm pronouncing his name correctly, formerly one of the senior guys at PayPal, also co-founded, I think, but at least senior management team, Keith Rabois.
Yeah, he's their VP of Strategy and Biz Dev.
Also hope I'm pronouncing his name correctly. Keith is somebody whose opinion that I respect greatly, and Max is very highly thought of. But there was a time where this company was seen as potentially being a billion-dollar, multi-billion-dollar company. A lot of excitement. What was their funding launch and their?
Yeah, in 2008, Slide had a $500 million valuation, according to TechCrunch, and they've been funded $78 million in funding over 4 rounds. Most recently, there was a $50 million Series D round in January of 08, led by T. Rowe Price and Fidelity Investments.
I mean, this is exact. Yes, sorry, Dan, you want to jump in?
I was just going to say that $50 million round, as Lon said, it was a $500 million, but that was a pre-money valuation. So the actual price that the VCs were putting on it was even slightly higher in the end.
Right. And this is sort of the problem in the industry, which is in bull markets, and let's call that 05 to 08, and in hyper-competitive markets, investors kind of can get ahead of themselves on valuation. And these kind of deals, they split one of 2 ways. I think the investors in Slide right now would not be looking so great, investing at 550 and selling for 182. And it seems in a way, Slide and RockU, the company that pulled away, was not even around or was not a competitor in that space back then, which is Zynga.
Yeah. Of course, yeah.
And right now, DST is looking really smart on Zynga and Facebook and other places. But I guess at the time, T. Rowe Price was looking smart on Slide. Dan, What are your thoughts on this deal?
My thoughts are that, I remember that $50 million round, and I remember just a lot of head scratching when that valuation came out. And it gets justified. We have this many users, and Facebook is growing, so therefore we're growing. And there was just a lot of head scratching. It was a very, very large valuation at the time, considering where Slide was, and it hasn't worked out well for them. It seems with a lot of deals and companies like Slide, if you can't sell it relatively quickly, with a couple exceptions, Facebook, Zynga, et cetera, you might be in for a world of hurt in the end.
I would say it was a talented team. They did sell for 182. Some investors won't have made the returns they expected. No. Let's hope there's some structure in the deal that at least allows them to earn positive results. But still, selling for 182 million is no mean feat. What's going on in Google's mind? Anyone have views on that?
I think this is clearly part of Google's attempt to get more serious about social gaming and sort of eat some of Facebook's lunch, maybe even just move this away from Facebook. And there's been a lot of movement around Google Me and them trying to sort of capitalize on pulling in more sort of Facebook elements to Google Me. They just have this Zynga deal brewing that TechCrunch has been reporting on constantly. So, I think it makes sense in that sort of logical progression of them trying to zero in more on Facebook's business.
It might also be a lesson to kind of hot startups. When you raise a big VC round at a great valuation, don't tell anybody the valuation. It never works out well for you because, if you end up selling for $800 million, then you get to promote that. But if you tell people and leak, as clearly the company did, that they had a $500 million valuation, now everyone's looking at this $182 million deal and saying, wow, that's a real disappointing deal. They wouldn't have necessarily done that if the leak hadn't happened a couple of years ago.
That's super interesting. And I don't know what kind of head fakes people try to do by saying high valuations. I know some people like to put a lot of data out there to scare off investors from investing in the category, but I'm with Dan. I think, be humble when you're raising money. You can pound your chest when you sell your company. Yeah. Let's get a little bit into some industry stuff. Dan, I'd like to kick off with you. There's a couple of topics you see more broadly across the VC sector because you report on it. You called it financial journalism. What's going on? There's in the seed area, there's a lot of discussion lately. I think unwarranted. How much discussion in seed relative to other categories? Some people saying traditional VC is dead, long live super seeds. Mm-hmm. Some people saying be careful as an entrepreneur from taking seed money from a venture capitalist because of the signaling effect. Some people saying, seed money is the only way to go and you shouldn't, whatever. And VCs are trying to argue, hang on a second, if you take money from a VC fund, if you hit another bad patch in the economy, VCs have deeper pockets. What's really going on here, Dan? Is there a huge industry-changing event here in seed funding?
I think there's an industry-changing event when it comes real specifically, which is kind of like internet-based IT and kind of mobile IT. I think we're seeing it there. You've got to realize over half of venture capital money goes into life sciences. That's not changing. There's still traditional venture capital, traditional communications companies, hardware companies, things like that. that's still going traditional venture capital. But in the space that, to be honest, gets the most attention on blogs, just because these are the people who happen to write blogs, we're seeing a bit of a change in that entrepreneurs now have a choice. And that's important. And those super seed folks, as you know, can often act a lot faster than can a traditional VC firm that's got to have a partners meeting and has to have a vote and discuss it. A lot of these super seed guys are individuals. If they like it, they can do it. For a startup that's really trying to ramp up quickly or get out there quickly, being able to get the money today or get the decision today, that's a big advantage.
Now, Paul Kudrowski, who writes a popular blog called Infectious Greed, wrote an article on infectious greed saying there's an upcoming bubble in the angel or super seed category. And his argument is there's too many people moving into that category. And in fact, prices relative to the risk that you're taking at that stage are creeping up too high. And while you won't hit a 500 million valuation on a seed or an angel round, if you're doing a 10, 15, 20 million valuation, you may struggle. And then people are arguing back, no, super seed, that stage of growth is just going to explode and be much larger because these kind of companies, Dan, that you're talking about just need less capital. Dan, where do you come out on that argument?
I think Paul's wrong today. He might be right in the future. Look, if you get a lot of big hits, if these super angels keep getting a lot of big hits, too many people eventually will flood into the industry, creating a bubble. But a few things. First, this is the seed stage part of the industry, the venture investing industry, was kind of left for dead or was really ignored for almost a decade, whereby VC firms, ones that traditionally had been doing first round deals, had moved later and later stage, kind of got a little bit risk averse after the dot-com crash. And so there was a big gap for people to come in. And there was a study recently, I think it was CB Insights did a study talking about how seed stage valuations actually have been relatively static, if not going down a little bit recently. To me, for there to be a bubble, you've got to have valuations being inflated. That's one of the things that gets inflated in an investment bubble. We're simply not seeing that yet. But look, if every VC firm out there starts launching their own incubators and doing their own seed stage programs, there will be too much capital coming in, and that will work out poorly for a lot of these firms.
What's your perspective on the signaling issue?
I think, I'm sure there's been some very bad situations that certain entrepreneurs have gotten into, and you can find some examples. In general, I think it's a little bit overblown, to be honest. It seems to me, so long as when you do that seed stage round or A round, so long as you can get more than one VC firm, if you can syndicate it and make sure you get at least two, which often you can do if you're able to get real investors, then I don't think you should have a really big problem. If both of your VC investors bail out on you before that A round or technically the B round, you probably have bigger internal problems than anything else. There's not a good reason for a VC to do that.
Gotcha. Interestingly, if I pick up on some of the week's announcements, Mike Maples raised $74 million for what I would call a super seed fund, or, I don't know if we want to call it a small A fund. The name of Mike Maples' fund is called Floodgate. He added a partner. Her name is Ann. I'm forgetting her last name. Maybe you could look it up for me, Lon, if you wouldn't mind, who is a professor at Stanford. Mike is hugely respected by entrepreneurs. I know he's respected by VCs. Ann is also respected as someone who...
Muraco.
I'm glad you had to say that. They are... It's interesting. It seems, Dan, that a lot of people in the super seed category are racing around doing 40 or 50 small investments, 100K, 150K, and just doing tons, maybe emulating Ron Conway. Mike Maples has publicly said he's only looking for what he calls thunder lizards. And I don't know if it's a Texas thing, maybe. Thunder lizards, the definition of which, according to Mike Maples, is things that can be enormously large. And I think if you look at traditional VC strategy, it says I'm going to do 20 to 30 investments in a fund. I'm going to find 2 or 3 that are seemingly popping. I'm going to put a lot of wood behind those deals. I want to own 30% of them. And when they become billion-dollar companies, I'm returning huge returns. First of all, any view on Floodgate, Dan, or any perspective on this? Can you build a fund out of lots of base hits versus kind of leaning down and going for a few big thunder lizards?
You can build a fund if it's just a couple people. You know, the size, the fact that Mike raised a little bit over 70, you know, the size that LPs who are investing in these, because these are real institutional funds now. They say kind of 30 million per partner for an early stage VC fund is about right. So in Mike's case, he's got 2 partners, 70 million. He's a tiny bit above that, so that makes sense. Yeah, I think you can you can spray, you know, the spray and pray theory. I think Mike is being a little smarter than that, but I think it can work. There's a lot of different ways that venture capital can work, and traditional venture capital, of course, hasn't worked over the past 10 years with median returns being basically zero, so maybe even a little bit negative. I think it can work. The thing that I don't understand, and it's not just Mike's fund, look, it was Andreessen Horowitz too, is this idea that originally one of the things about getting a venture capital firm behind you was you're going to get a board member and you're going to get someone who's working with you constantly. You can always get on the phone. Once you got 20, 30 deals, they're not taking board seats, you lose a lot of that advantage.
Yeah. I guess I would say I'm probably a dissenter saying that both strategies work. I like to say that Ron Conway is the S&P 500 of venture capital. And I just use that as an analogy. What I mean is Ron gets into every great deal, and any great entrepreneur knows that anyone who's worked with Ron gets tremendous value from that. And as a result, he may, and I don't know his numbers and I'm not suggesting, but if he does 50 deals and 45 of them don't work out, he still makes sure he's got Google, Facebook, and Twitter.
Right.
I think if you don't, if you're not afforded that same opportunity as Ron, it's hard to own 60% of the S&P 500 and derive S&P 500 returns, because often the returns come from the outliers. I don't know, Dan?
No, I would agree with that, and you know, I'm not so sure that somebody like Mike, as you said, he's looking for these so-called thunder lizards. I guess Thundercats was copyrighted, so you know he's looking for these thunder lizards. You would hope and think that he is going to double down on those. That he's spraying around a bit, and he's going to double down and triple down and quadruple down on the ones that after 6 months, a year, that he sees could be the real growers.
Well, that's exactly it, and I think that's the right strategy, Dan. It's in fact. I would say the opposite about Mike, which is Mike seems to have been very focused and judicious in his investments so that he reserves capital for ones that he perceives are thunder lizards that are growing. So as you said, Dan, he can put more money to work.
Thunder lizards actually is the, in Latin, dinosaur. That's what the term means.
Okay.
That's what the thunder lizards are dinosaurs. That's what that word means.
Really?
Yeah.
You're not joking?
I did not make that up. That's
okay.
True.
Interesting. Well, it's good to have a factoid person on the show.
There you go, if you're ever doing Jeopardy.
So in the category, Dan, I don't know if you followed the weird announcement on TechCrunch about 500 startups, which is Dave McClure announcing a $30 million early stage fund. The reason I call it a weird announcement is they didn't say Dave McClure has closed a fund. They said Dave McClure has registered with a commission that he's raising a fund, whatever. Did you follow any of that, and what's really going on? Any views?
Yeah, I mean, what Dave did was, there's a variety of reasons why you should file so-called Form Ds with the SEC, and one of them is if you're basically going to do a private placement offering, which really is what a venture capital fund is, if you haven't already raised the money but you've started marketing it, you do have to register saying, basically, we're offering this amount, how much have you raised? In Dave's case, he's raised none. He's just starting to raise this now. I will say my understanding is he does have some commitments from individuals, but he's really doing the institutional fundraising, the endowments, the pensions, or whoever else. This fall, I know a couple people he has meetings set up with. So he's got a little bit of money in, but yeah, he hasn't raised a $30 million fund. He was getting all these congratulatory notes on Twitter. He hasn't done anything yet. I mean, you know, I'm raising a $30 million fund. Will people congratulate me? He'll probably get it done eventually, but it's a strange thing the way it got treated.
Is that breaking news, Dan? Are you raising a $30 million fund?
I am. I expect congratulations, and I want some. Yeah.
It's DANPRIMACK. You can send congratulations to Dan Primack.
Well done. Congratulations.
Yeah, congratulations.
That's exciting.
I have to say a couple things. I did not send Dave a congratulation message. I sent him a message saying, does this mean you closed your fund? Because I wanted to know. Yeah. And, you know, you called it strange reporting, Dan. I do, too. I think TechCrunch could have been a little bit more clear about what it meant. I will say a couple things to Dave's defense. Number one is he is now writing checks. So he obviously got to close, as you said, Dan. One of them is on camera. They have a picture of him writing a check to Tello, which is a stealth startup by Joe Beninato. I hope I'm pronouncing that right. I know what they do, but I can't say since they're in stealth. A very seasoned entrepreneur there. And I know that he wrote another check to another deal I've been looking at because the founder said, I just got a $50,000 check from Dave. So Dave is out there writing checks. He's got some money closed. And the only thing I want to correct, Dan, is he's not starting to raise his fund right now. Dave has been raising money for about a year. He's met with several people. So I'd say probably what happened is he did a first close on the 30 million and is now trying to sweep up final commitments. So the question, and we don't need to know, but did he close 5, 10, 15, 20, 25? Who knows? But he's got money to put to work, and a lot of entrepreneurs want Dave McClure's money.
There's something interesting about that, actually. Dave, when he originally went out fundraising, at least from rumors, and he didn't tell me this personally, my understanding was he was only looking for about $10 million. And then this SEC filing comes out with the 30. And what's worth noting about the filing, it was dated, I guess, it came out Tuesday or Monday. It was dated that same day or the day before. And as of that time, it said he had sold $0. So it was zero of that 30, which makes me think, and I'm just speculating here, that $30 million fund is considered an institutional fund. And he has some sort of side vehicle that he got from the individuals where he had that first close, which means he actually might be trying in aggregate to raise more than 30.
Interesting. So I will say, just for viewers so you understand how venture capital works, we are very weird about fundraising. Number one is no VC's ever fundraising. I've said this before. We pre-market. So when people say you're raising money, no, we're not raising, we're pre-marketing. Pre-marketing means we're raising, okay? And then we try to announce nothing until we raise money, and we call that a first close. And a first close, I mean, what's different about entrepreneurs who raise money? You're typically raising money from 1 to 5 individuals. Maybe if it's angels, it's more. We might be raising money from 25, 30 people, so it's kind of herding cats.
Right.
And if anyone's interested in the topic, if you search on Business Insider, Alan Patrikoff wrote a great article on what it's like as an early stage fund to raise money and how difficult it is to herd cats. But the other interesting thing is we have a number, we call it putting it on the cover. So on my cover, it might say I'm raising $40 million. I may have totally different targets. I may hope to get to 60. And I just don't want to seem like I fell short of my target, so I put 40 on the cover and really raise 60. I don't know if, I know people do that for sure. I don't know if people put 30 on the cover hoping to get to 10, but I know people definitely lowball what's on the cover with an expectation of trying to raise a bit more.
And they also, just to get even more technical, the thing Dave filed, or the thing that TechCrunch picked up on and we picked up on, wasn't the so-called offering document, which he's passing around to prospective investors. It was something with the SEC, and you'll often actually there see people file for more money than they're actually trying to raise, if only because by doing so, you don't have to file an amended filing later, which costs money. You often get recommended by lawyers or accountants, say you're raising a little bit more than you actually are, just so that you don't have to pay the money to do another filing.
We need to have you on the show more, Dan, because there's a whole demystification process that needs to happen about what I'd call upstream venture capital, which is not how we deploy cash, but the whole structural industry and how we raise capital that I think would interest people. Another topic I want to cover, which is not yet on deals, is sticking with this idea of the changing nature of venture capital. Some people have argued that you just don't need as much money to build big businesses these days. Now, I know people like Fred Wilson on avc.com has said it's true there's a changing structure where deals get done with less capital, and that's great, and let 1,000 flowers bloom. And he's saying let's have 10 more Dave McClures because that just means more entrepreneurship. But he has argued, and I tend to agree with, for the companies that are going to build billion-dollar companies and really build big, meaningful businesses that become a Google one day or an Apple one day, if we want the next Google or Apple, if we want Zynga to be huge, if we want Facebook to be huge, those require big checks to build out management teams and build scale and afford CapEx, capital expenditures on hardware and facilities and so forth. And so what I've argued is I think each market needs the right size. You have a right size for angel and seed. Maybe that's expanded in recent years because it's cheaper to start companies, but you still need a good market for A rounds, a good market for B rounds, and a good market for these later stage vehicles like Insight Venture Partners, Summit Partners, Francisco Partners, TCV, DST, and a number of the other ones. Or, Dan, is the industry just changing and that goes away? What are you seeing?
No, I think you're right about that. I talked earlier about the fact that so many of these super angels and seed stage people are coming in because there was this gap. Venture capitalists ran away from the early stages. Well, now a lot of venture capitalists are running away from the later stages because, they want to be Twitter. They want to get the next Twitter or Facebook. They want that grand slam, and instead they've seen kind of middling returns from the expansion stage, late stage. But you do need that. And it's funny, you mentioned kind of is it the venture market that's changing. I think also part of it is the entrepreneur market has changed a bit. I think there's a lot more satisfaction right now among entrepreneurs for selling a company to Google or to Cisco or to whoever, as opposed to we want to build $1 billion company. We want to build a $2 billion company. I want to be CEO for the next 10, 15 years and have this be my legacy. I think there's a lot fewer of those entrepreneurs out there right now than there used to be. And I think that's being reflected in where the venture guys are going and where how the companies are being built.
That's true, Dan. I always quote Bill Gurley on this. Bill Gurley is a partner at Benchmark and a former stock analyst. And he kind of equated it this way, which I agree with. In the 90s, when I started being an entrepreneur, late 90s for me, going public was almost like moving from the minor leagues to the major leagues. Mm-hmm. And every founder, every CEO like myself you would talk to would always say the same thing. What are your plans? I'm IPOing. I'm going to build a company. I'm going to IPO. I'm going to run a public company. I think with Sarbanes-Oxley, I think with the pressures of being public, from a stock market that no longer just goes like this, but has a lot of volatility to it, I think people see that as, okay, I IPO, but I might be locked in for 2 to 3 years and not able to sell my shares, not able to diversify my own position. And it's just not something that everybody aspires to anymore. So, Dan, I tend to agree with that assessment.
And you asked about the late stage. We have not seen, and I've actually been surprised, we have not seen any significant number of new players come into kind of the expansion stage, late stage part of the venture capital market, like we've seen a bunch of seed stage, early stage players. I'm kind of waiting for it. You had a bunch of so-called growth equity firms that got raised, or funds that got raised a couple of years ago. Even some established names like Northbridge and Excel raised growth equity funds, but that's much later, and arguably almost kind of like mid-market or small cap leverage buyouts than it is venture. I think we're going to need that if you're going to see those billion-dollar hits, which is what the early stage and seed stage VCs really need to move their needles and get their next funds raised.
It's interesting, Dan. My assessment on the market, I'd be interested in your view, is there is an abundance now of angel and seeds, and you guys on your other shows must see this, just how many deals are getting done and announced these days, right?
I mean, in the news for This Week in Startups, it used to be I would find, even when we first started doing the show, you would find just about the right amount of stories to have on the show each week. And now there's 3 times more stories than I can possibly cram in. At the end of the show, I'm always like, well, there's 8 more things left. Let's pick this one.
Interestingly, Lon, I am going to go on the side of there being a mini bubble in angel and seed. Mm-hmm. Not that I disagree that structurally things have changed, but Dan, I will tell you anecdotally from the deals that I look at, prices are creeping up. Angels are feeling bullish. I think their personal net worth has returned with the stock market. They're not worried about their real estate investments. They're willing to write checks. Maybe they got in early out in an Invite Media that launches and gets bought by Google for $70 million before even really trying. And I think that's created this new bullishness. But I'm a big believer that angel investing is a bloody hard business to make money at. Mm-hmm. You've got to have 20, 30, 40 bets. You've got to be able to lean down on some of your biggest bets, and that a lot of people are going to lose money. And those losses are going to come 2 years from now, and that will pull some of the steam out of the angels. Forget professional seed funds, but like the angels who are just writing checks in hopes of being the next Invite Media. I think that will die down a bit, would be my view.
So do you agree there was that at the Y Combinator Angel Conference, Ron Conway and Mike Arrington were sort of having this argument where Conway was saying, the more people funding companies, the better. We're funding innovation. And he cited Facebook, Google, Twitter. Like, where would those be without funding? And then Mike Arrington came and said, we're training an entire generation of entrepreneurs who are building, I'm going to swear, dipshit companies, is what Arrington said. So which side of that, or you seem to be coming down sort of in the middle there.
It's good that you're kind of flushing me out because I avoided trying to be public about this topic, but I'll go on record. I'm more in Michael Arrington's camp. So Fred Wilson wrote a follow-up blog in which he's saying, again, let 1,000 flowers bloom.
Right, yeah.
Now, as an A round or seed round venture capitalist, I have a vested interest in that happening. If people are willing to fund 1,000 flowers, that's great. That's just more bites at the cherry for early stage venture capital firms to look for deals. So we have a vested interest in seeing that happen. I don't think it's great for the economy overall, and I want to say why, and I know that not everyone agrees with this. Number one, I think having healthy markets means that you have sustainable angels who want to participate for the next 5 years. If we burn a bunch of them out by throwing spaghetti against the wall, they're not going to be there. And this is the same way the retail investors are afraid now of IPOs, because retail investors on the NASDAQ got burned after 2000, 2001. If you look in Germany at the Neuer Markt, it completely went away. Nobody touches that anymore. If you look at the AIM mark in London, too many people have been burned by public markets. Burning the angel is not good. And importantly, burning customers. This is the thing. I wrote a blog post. Lots of people love to be angry at me about this, but I said the fail fast mantra needs to fail fast. And what I mean is this, is too many people have this idea that I can just throw spaghetti against the wall, hope it works, not either do enough market research on the quality of the idea, or if it's not working, find ways to continue building your company. They're quick to say, well, that didn't work, on to the next. And the problem with that is this. It's not just that you burn the angel's money, Elon, you also burn the customers. Because if you're Mint.com, Mint didn't do this, but just as an example, or the 20 other people wanted to be Mint, and for each of you, I signed you up to integrate with my bank account, and I gave you a bunch of personal data, or for every site that asked for my photos or asked me to connect 25 friends, if you're blowing me up as a consumer, I lose trust in the entrepreneurial market. That's not healthy for the industry. So I'm afraid I'm going to have to dissent from some people I really like and respect on this. I'm guessing, Dan, you're on the 1,000 flower bloom side.
I mostly am. I think it's really incumbent on the angels to be smart. If you're just an angel who says, oh, well, so-and-so invested in it, so I'm going to invest, you do have to do your own due diligence, and you also really have to be able to look the entrepreneur in the eye and basically say, I'm going to get my money back, right? I mean, that has to be explicit, not just that, well, hopefully I get it back, go for it, have fun. You got to be really explicit. I expect to get my money back plus something, at some point. It shouldn't just be considered a handout. It's an investment. It's almost kind of a loan in early stages. But yeah, I am more let 1,000 flowers bloom. I get the sense, or I have the feeling, when I sign up for a new, particularly a web application or a web service, I half expect that it's not going to be there in 6 months. I kind of feel that going in.
But you and I, Dan, are on the sophisticated part of the market. Lon, you're on the sophisticated part of the market. We understand this, but my mom doesn't.
I think we see this a lot. There's all the time tech stories now about these companies that kind of came and there was this new product and then people had a sort of problem with it, or it doesn't work, or it fails. I mean, Flipboard was a good recent example. And the majority of the public just gets frustrated. They don't get it. They don't understand, because that doesn't exist outside of tech. I mean, if I go to the supermarket and buy a candy bar, it's going to taste delicious. I don't expect like, oh, well, this particular version didn't work because this is an upstart company and in 10 years it'll be delicious. And I think that people, it hasn't sunk in that the web is sort of growing like this, or tech is growing.
I will say on the first order derivative, I'm a beneficiary of all this, because it just gives me more opportunities to see what bubbles up. And I'm not a guy who's going to invest in 40 of them.
Right.
We're pretty judicious. Our strategy has been pick your companies carefully, be very active, 5 to 10% of your investments are going to return the majority of your returns. I've talked about this publicly. Ulta, which is in our last portfolio, returned $320 million. That's great. Another one I couldn't talk about, but now I can. InvestNet just IPO'd last week. Dan, you covered that deal. We're approximately 30% owners in it. I don't have the exact figures. It's somewhere on the order of $400 million market cap. And I'm not going to give any forward-looking statements. I will just say that venture returns have been driven by these outliers. And it's going to be smaller numbers going forward, but I believe that's how investment returns are calculated. So I'm a beneficiary on the first order of it, so I'm okay for it to exist. On the second order, I think it maybe will cause us some problems that we all have to sweep up in a few years from now.
I just wanted to add one quick thing on that, which is, going back almost to that whole, are they creating billion-dollar companies? It's also important to remember, when you get a billion-dollar company, when you don't fail, when you stick it out, when you can create something great, and maybe that means changing your business model 4 or 5 times, like say even like a Google did, that ends up creating tons of other companies. And I don't mean carve-outs or spin-outs, but executives who've had some success, who've had some money, who create new startups. I'm based here in Boston. That's always the conversation. Because we don't have Google, because we don't have Cisco, because we didn't have HP, we don't have as many entrepreneurs here because they're not coming out of companies. If we don't get more VC-backed billion-dollar, multi-billion-dollar companies, there'll be fewer good seed-stage deals in the future.
Dan, that's something I talk about all the time. That's the issue with Los Angeles. We have produced a tremendous amount of $200, $300, $400, $500 million exits, but we don't have a Google to show for it. We almost did. Overture could have been Google. It didn't turn out that way. MySpace could have been Facebook. Didn't turn out that way. But you need those feeder companies like Seattle has, like Austin has. Austin less so, but Austin has some of it. But Silicon Valley has in spades.
Great.
Dan, one of the things I was going to drive towards is, as we've seen this abundance of seed, I think there's also been an abundance of A. I think everyone's very comfortable with the $2-3 million checks. And then when a company gets through to proof points like a Zynga, like a Hotlook, Guild Group, like where you're seeing real revenue, getting that C round is easier. I think there's a gap in the B round, because the B round, you're hoping to get $20, $25 million valuations, pre-money. You're hoping to raise $10 to $12 million. You often don't have the proof yet that you are worth that. And I think that's a little bit of a gap.
It is a gap. I mean, can you think honestly of a venture capital firm that specializes in B? Because I really can't. There's a lot that specialize in A. There's a lot that specialize in C and D. But a firm says, we are a B round investor. That's what we do. We're the second money in. There might be a couple. It's extremely rare as a model, particularly because you're right. You're asking them to take not quite the same risk as the A, but a lot of risk.
Yeah.
And you're asking them to pay more, both in terms of valuation and dollars for it. It's a really tough place to play, and not that many people are doing it, at least not as a primary focus.
Yeah, I agree with you entirely. And also there's a feeling in the past where you shop your A deals to me, I'll shop my A deals to you, I'll do some B, I'll do some A. But I think nowadays people prefer to focus on what in my portfolio am I going to help grow. So B is that gap. DAG Ventures famously is a B investor. They tend to follow on only from 5 funds: Sequoia, Kleiner, Benchmark. I can't remember what the other 2 are, but they follow only 5 funds. And the second is, I think Scale Ventures is known as being a B round. Maybe A also, but I think they're B. I don't know, Dan, am I wrong?
Scale does do some A's, and Scale obviously is both IT and biotech. DAG, I guess DAG does do B's. I always think of them as a slightly later player, often doing C's. But you're right, they do some B's. But as you said, they really follow on specific funds. They're not doing every deal or doing deals from everybody.
I want to make sure to take a quick break to thank our sponsor. Our sponsor is LegalZoom. Dan, have you ever used LegalZoom, or do you know who the company is?
I know of the company, never used it.
Okay. Well, I can tell you that I actually have used it. I used it for personal reasons. I actually rent out a house. I did all the legal documentation using LegalZoom rather than a lawyer. And this was phenomenal for me. They gave me a packet. I could fill it out easily. It gave me all the documents I needed to give. There's a lot of regulatory stuff you don't think about when you do real estate. or any transaction, and they give you the documents if you want to rent a house to give the tenant that they actually need to sign off on. We talked about last week, for example, you can use it to do trademarks. We talked about a case in which there was a company that owned the URL for Groupon.com, didn't have the trademark for it. Groupon, what we now know of as Groupon, managed to get the trademarks on the business and was able to negotiate the URL as a result of that. So whether it's business, whether you're doing your company registration or a trademark, LegalZoom is a great option for managing your costs. Or whether you're an entrepreneur and you just want to use it in your personal life and you have legal things like a will, God forbid, a divorce or something. There's the legal documents there.
Yeah, I mean, even things like changing your name, or starting an LLC. I mean, all these little sort of things that if you don't have a lawyer on retainer, personally, that you can just go there and it's so much faster.
And perhaps Dan Primack can use it for his new $30 million fund.
Sure.
If you are a This Week in Venture Capital viewer, you actually get a discount.
Oh, great.
So you need to enter TWI in the referral box at checkout. It's actually not a law firm. That's the one thing we need to be careful about. But it was created by top attorneys to help
Robert Shapiro.
Yes, including Robert Shapiro famously, to provide self-help services at your direction. If you like the show, please send out a tweet thanking our sponsor, LegalZoom.
At LegalZoom.
At LegalZoom.
Yeah.
Let's get quickly to some deals so that we don't run out of time. There's some deals I want to cover this week. Dan, YouSendIt raised money. It's a file sharing service for sending files up to 2 gig in size. It says they're getting 300,000 new users a month. They just raised $15 million, a pretty whopping round, a Series D as in dog, by Adam Street Partners. Previous investors, Emergence Capital, Sigma Partners, Alloy Ventures, $54 million total round invested. What's going on with YouSendIt?
Well, I think this shows what we were just talking about, which is that late stage funding is often going to be needed for companies, and that when you're getting that A round and B round, that you really do have to at least mentally kind of look a bit down the road. Notable, there's 2 early stage investors, including Seven Rosen, that aren't in this round. And the CEO made some sort of comment about, oh, well, we had to let them fall out of this round to make room for Adam Street, which makes absolutely no sense whatsoever. Everybody could take a little bit smaller pro rata if they wanted Seven Rosen to come in. It's more that Seven's got its own funding problems. But, it's really, there are a lot of companies that still need to raise money later, and this is a company that has revenue. If you just add up the numbers, it should have at least, $25 million in revenue, probably more. And so it's a real company. Unlike some of the VC-backed stuff that gets talked about, this is a real company with real revenue with a real product.
YouSendIt is a real company with a real product. I knew them when they first started. The idea was pretty simple, which is you've got a large file to send. Often when you want to send it via email, a lot of corporates will block file sizes above 10 meg.
And it just takes forever, and then somebody's on the other end trying to get the email, and it's taking forever, and it blocks their email box. Yeah.
Exactly. And on top of that, you can't track whether or not someone actually received the file, and you can't rescind it if you send an email. If you send something via a product like YouSendIt, you can rescind it. Here's what I think's going on. I think, number one, Dan's right. I think it's a real business with real meaningful revenue. Yeah. Number two, I think they've seen the success of Dropbox. And Dropbox is a new way to send files around, has raised a shit ton of money, and that's actually a technical term that we use in venture capital. And it's funny because sometimes you get the new players. Dropbox was a Y Combinator company that become new and sexy and exciting, and it's hard to be the old line company that's doing similar stuff and to get people excited again. Everybody I know is using Dropbox. But they're using Dropbox or they're using YouSendIt for real reasons, which is moving large files around with the degree of control and management. So they got funded this week. Another deal I'd like to talk about, Dan, is Shopkick. Let me just give you the stats and I'll weigh in for your view. They just raised $15 million from Greylock Partners, bringing their total amount raised to $20 million. The previous investor was Kleiner Perkins. Reid Hoffman, famously of LinkedIn, was also an angel investor or invested in that first round. He's now a partner at Greylock. No cookies for guessing how Greylock got in on the deal. The founder is a gentleman named, I'm always worried I'm going to pronounce this wrong, Cyriac Roding. I've actually talked to him on the phone. Very nice guy, very smart. He was an EIR at Kleiner Perkins, which probably just means he percolated the idea while they were paying him a check. He was the founder and EVP of CBS Mobile, created the first location-based mobile ads in the US together with Looped. Part of what Shopkick does is they allow check-ins in the way Foursquare, Gowalla, Booyah, My Town, blah, blah, blah,
Yelp.
blah, blah. Some of the things they're claiming is that they can physically ensure that you're in the store. They're using technology other than GPS, probably in-store technology that can actually assure that you're in the store. And they're focused on the retail sector. They've done a deal with Best Buy, and the idea is you're in the store, you're auto-checked in, and suddenly we know you're in the store, Lon. We know last time you were here, you bought a flip camera. We think this time you might appreciate a camera stand so you can shoot all your video, and we could shoot coupons to you.
Man, it is very Minority Report. Remember that movie
Yeah,
where he walks
of
into the
course I
Gap
do.
and they're like, hello again. You got this last time.
Well,
It's
so
exactly the same idea.
Shopkick is making one segment of Minority Report working again. And they also launched a product called Cosworld in 2009, which used karma points for walking into stores and checking in. And you could use these karma points to do real-world donations. Dan, any views on this company?
I don't exactly get it. And look, and Reid Hoffman's also in Gowalla, so he's and obviously the companies are a bit different, but he's making a variety of bets in kind of the location-based mobile app space. I don't exactly get it, to be honest. I mean, it would seem to me that they've got to get such wide distribution in so many big retail chains. One of the reasons, and by the way, I don't exactly understand Foursquare either as a business model, but one of the reasons something like Foursquare is so popular and successful is that you can check in everywhere. Your local bar, your local laundromat, whatever it is, you can check in everywhere at the airport terminal. In this case, it's going to be so specific to a couple chains, at least in the beginning, but it seems to me that the usage is going to be relatively low. Oh, am I in a store that uses Shopkick? It just seems really limited unless they can get mass distribution. And to me, that's their big challenge. How many retailers, big retailers, can they get into? And then can they spread out into smaller ones? And will smaller ones look to adopt them? I think it's a tough sell.
Okay, I will say it's a talented team. It's a smart team. Not just the actual team who's building it, but the investors. Matt Murphy from Kleiner Perkins, who runs the iPhone, is the guy who did the investment. I will say, just to be clear and on the record, I have an investment in this space. I don't believe it's going to be competitive with Shopkick. It is right now in stealth mode, but we are in retail shopping. I think we're going to do things differently. We're not trying to be a check-in service, but I just wanted to make clear that I don't think it will be competitors, but I didn't want to not say it. We wish these guys good luck. There is a question coming in over the, what do we call it, chat line?
The chat line.
Chat line. It's from
The
John.
chat room.
Chat room. John Humphrey _. John Humphrey is asking, does anyone know how Dropio is doing? Dropio is another file sharing product. It's drop.io.
Yes.
I played around with it a bit in the past. The idea is you can have a sharing area that has its own unique URL. You can see one up there on the screen. And you don't have to send out folders. People don't need passwords and logins. It's easier to share things. They make the code unique so that when you share it, it's not detectable by other people, bots who could go and find and download your documents. I don't know how they're doing. I don't really have a view. But
well, Dropbox does have that functionality. I mean, I can get a URL out of Dropbox I can send somebody and they can go access just that one file, so I don't have to let them into my entire folder.
So what I suspect might be going on, Dropio was founded at about the same time. Sometimes the wheat gets separated from the chaff, and one company raises a bunch of money that give them the resources to try and differentiate product. That doesn't mean Dropio won't have a market to focus on, but I think Dropbox is really, there's two companies that seem to have sucked the air out of this market in a positive way for them. On one side is Dropbox, and on the other side is Box.net. Seem to be the two companies. And of course, in the public file sharing, we have Scribd, you have DocStock, you have SlideShare. There's a number of people competing in that category. I want to move on to a couple more deals. There's a deal, Dan, called Keep, spelled K-I-I-P. There's not a lot out on this company. It's in stealth mode. They're looking to work with prominent iOS game developers and people who have a large presence with national retail brands. That's all we could pry out of them. They're building a mobile advertising, non-traditional mobile advertising platform, bridging the real world and the gaming world. What interested me about this deal, why I wanted to talk about it, is they raised $200,000 from True Ventures. It's their first closing. They are raising a slightly bigger round. But it was raised by Brian Wong. Have you met Brian?
I have not met Brian.
Brian graduated university in Canada at 18.
Yeah, he's 19 now.
I know Brian. I respect him. He founded his own company. It was called Follow Formation. He had a little design firm called Air Marketing, AER Marketing. And I spent a lot of time with him when he first graduated at 18. God, I could be the guy's father. It's really scary. If I had started young, mind you. If I had started at 12, I could be his father. And he's just really mature for 18 years old, having graduated, having started a company. He chose to get some Silicon Valley experience, went to work for Dig. And it's, Dig itself was right sizing, so a lot of people lost their jobs at Dig. And he said, okay, I'm going to go for it, and I'm going to build my own business. Interesting about Brian is he really has made rounds in the Silicon Valley circles. A lot of guys know and like him.
Sorry.
No, go ahead.
I was going to say, this round, at least the original report on it suggested that it might not be done yet. So True put in 200,000. There might be more to come after this. This round might, some of those rounds he made in the Valley might still pay off on this deal.
Yeah, Dan, it is. I know firsthand information, which I won't reveal details on, but it is a first closing. He will get this round funded. I feel very confident of it. Kind of reminds me of WordPress. And I don't mean in a product way, but Matt Mullenweg, when he raised money, was I think 20, and True Ventures backed him.
I believe he was 21, actually.
Yeah, the report on TechCrunch said 21. My memory was 20, but I don't know. I'm guessing their fact checkers are better than my memory. So let's call it in the 20 to 20. There aren't many 19-year-olds who can raise money. I funded a local entrepreneur in LA, Sean Rad, at 23, and that felt young. But True Ventures seems to be out there to find extraordinary talent. And if you're at that young age, already doing startups, graduated college, making the rounds. I mean, I invited him to a dinner in San Francisco, and I was sort of embarrassed because, you get in this mindset of just assuming everyone can drink.
Right, yeah.
But here's Brian with his fake ID.
Oh, my gosh.
Drinking at the table.
That's ridiculous.
But congratulations. We're looking to see what comes out of Keep. There were a few M&A deals I just quickly want to cover, Dan, because I know you cover M&A. Hot Potato was bought by Facebook for $10 million. Any views there?
Not really. I mean, look, the Facebook, one day Facebook buys something, then today Google buys something, and Facebook buys something, and Google buys something. It's just a race to snap up as many startups as you can. I mean, it's not a huge amount of money, but it's a reasonable amount of money, it seems, for what Hot Potato is. It just seems like Facebook and Google are throwing as much money as they possibly can into the Valley to scoop up as many things, throw a lot against the wall, and see what sticks.
I would agree. I would say ultimately for me, this is a talent acquisition. At $10 million, I would be surprised if they use the technology, but instead are looking to kind of bring in what they perceive as the best and brightest into the company.
That makes sense.
Other deals that we saw this week, a company called Tuenti, Tuenti, was acquired for $99 million. It is known as the Spanish Facebook. Telefonica purchased 90%, not 100%, 90% of the company. You ever come across this company, Dan?
I haven't come across them, but I think there is a little bit of venture money in there. I think selling is fantastic. I think anytime you're the Facebook of and then fill in a demographic or a geography, it's good to sell when someone's willing to buy you, because you don't want to become, well, ultimately say what Abibo ultimately became when that was, the Facebook of Britain. The Facebook of anything would worry me. So get out while you can. And for Telefonica, they tried to launch their own social networking thing about a year ago. It didn't really work out for them. So this for them is the next best thing.
It's interesting. I did meet the founding team. I met them early enough in their company's evolution. A couple of young American kids, actually, who said, I think if anything, maybe they even went to Harvard at the same time as Mark Zuckerberg. I'm not sure. We'll have to wait and watch in the movie, which I saw the promo of. Have you seen the promo for the new?
Yeah, with that kids choir singing "Creep."
You know, that's one of my all-time favorite songs.
I love that song too.
Absolutely love Radiohead.
And the lyrics match up so perfectly. I mean, it's such a brilliant.
He said it, not me. Okay, so I just
well, not even just about Zuckerberg, but Facebook itself.
Yeah. You know, for sure, it was great. I'm looking forward to that movie coming out. But so I met the guys, and you know, they did what the Summer Brothers do in Germany, which is if you can discover what's popping in the U.S. and race off and do it in another country, get in early and look to sell. You know, this model, I'm not saying it's a great model, but it's worked for a number of companies, particularly the Summer Brothers in Germany. And what they were trying to figure out at 20 was, do we become the social networking platform for all of Latin America? Do we become the Spanish-speaking platform globally and try to take on Facebook with the Hispanic market in the US? Or do we keep in Spain and say, well, we can be social networking, but we can also be PayPal and eBay and everything else and kind of go broad? My advice was very similar to Dan's, which is sell while the getting is good.
Makes sense. I mean, yeah, if you're the Facebook of whatever, what's stopping Facebook from just, you know, starting it and drinking your milkshake?
Yeah, exactly. Good. Well, listen, that's all the deals we have this week. Exciting week, both in terms of financing and M&A. Always fun to hear Dan Primack's point of view. If you're not following Dan Primack, it's at DanPrimack. I got that right, Dan?
Got it.
And he writes great stories, and he tweets authentically as an individual. And I think he's kind of a champion of entrepreneurs, so I think you'll enjoy following him from PEHub. So thank you very much, Dan.
Thanks, Mark.
Thank you to Lon.
Always a pleasure.
Yeah, for being my beautiful counterpart here. Joining the Facial Hair Club,
welcome.
Which John Stewart copied me. And, of course, a big thank you to LegalZoom, our sponsor for the show. If you want to use LegalZoom and you want a discount, TWI in the referral box. And LegalZoom is not a law firm, but it was created by top attorneys to provide self-help services at your direction. Next week, I'm actually on vacation.
Oh, wow.
Or am I? No, I'm not. We have a very special episode next week. I'm really excited. Brad Feld is going to be here.
Oh, wow. Great guest.
He's going to be in the house. Brad Feld from Foundry Group from
Very
Boulder.
exciting.
The following week, I'm on vacation, but we have pre-recorded Howard Morgan from First Round Capital. I got a great interview already recorded about how First Round started and how the co-founder, Howard Morgan, thinks about the venture capital industry. Make sure to tune in.